Hello and welcome back to the Geordie Pig Invested channel. In today's video, I'm going to reveal my full Trading 212 UK dividend growth pie. I did a similar video to this one earlier this year, but after having multiple new requests and also changing some of the stocks within the pie itself, I thought it was a great time to share it again with you all. This portfolio is designed for long-term sustainable passive income with a focus on solid UK dividend payers, consistent growth and compounding power. I'm a huge fan of this portfolio as every single stock is listed on the London Stock Exchange, and because I hold all the stocks within an ISA, all dividend payments I receive are tax-free. So whether you're a beginner looking for a starting point or a seasoned investor curious about what's inside, this is the deep dive you've been waiting for. I'm going to break down every stock, the weightings, the yield, and exactly why I picked each one. If you want to see a similar breakdown for my US dividend growth pie, then smash the like button, and if this video reaches over 100 likes, I'll make sure to do it. You can also copy this exact pie if you click the link at the top of the description. And here are all of the different stocks within my ultimate UK dividend growth pie. As you can see on screen, the dividend yield currently sits at a very promising 5.77%. The yield on cost is actually at 5.6%, and this is the number that's going to be important because it shows you what yield you are personally receiving from the investment you've made, because if you buy a stock and it was to go up by say 10%, then the yield on offer will now be lower than the yield you were able to buy it at, giving you a higher yield on cost. So it is a measure used by investors to evaluate the income return from an investment based on the original amount invested rather than its current market value. I find it really useful because it tracks long-term income growth, which is great for us dividend growth investors. As you can see on screen right now, the overall portfolio dividend yield is at 5.6%, and it has a very nice 5-year dividend growth rate at 12.31%. With the portfolio having 9 holdings, the ideal scenario for myself to build over the long term is to have around about 11% allocation to each position within the portfolio. But due to some positions within this portfolio having better buying opportunities, I've ended up having a slightly different split as it is right now because I saw a fantastic opportunity in Greggs earlier this year, hence why it currently has around about a 23.5% share in the portfolio. But over time, the goal will be to build up the other positions so eventually they even out to around about that 11% mark for each holding within the portfolio. And the first stock we're going to look at in today's video is BAE Systems, stock ticker BA. BAE Systems PLC is a British multinational defence, security and aerospace company. It is one of the largest defence contractors in the world, serving governments and militaries globally. BAE's key clients include UK Ministry of Defence, US Department of Defence, NATO allies and various Middle Eastern and Asia Pacific countries. They are also involved in next-gen aerospace programs including hypersonic weapons, satellites and military drones. As we can see, year to date they're actually up 51%, so had a pretty strong year overall, even though they have had a bit of a price pullback recently. Their current price is £17.38. They're part of the industrials industry with a market cap at 50.81 billion. Went public in 1981, have a 9-year current dividend growth streak and a 5-year dividend growth rate at 6.46%, with a dividend yield that sits at 1.96%. When having a closer look at the analyst consensus, we can see that it is overall around about a buy, with there being mixed opinions though. We do have 1 strong sell, 2 sells, 3 holds, but as you can see it is overweighted towards the buys and strong buys with 9 buys and then 6 strong buys. And the overall price target for BAE Systems is around about 2,055 pence, which is 19% above the current price. So I own a BAE Systems because it sits at the intersection of defence, technology and global security. With the world becoming more unstable, defence spending is rising and BAE benefits from long-term government contracts and strong partnerships with the UK, US and NATO. The company is also expanding into high growth areas like cybersecurity, space and next-gen military tech, giving it both stability and future upside. Add in a solid growing dividend and BAE becomes a reliable cash generating business. It offers resilience, innovation and consistent income, exactly what I'm looking for in my UK dividend portfolio. When it comes to dividend tracking apps, Snowball Analytics is hands down one of the best out there. Look, if you're investing and you need a good portfolio tracker, this is like the Rolls Royce of portfolio trackers. I've been using it since day one of my investing journey and it's been a total game changer. So you're going to have no more wrestling with spreadsheets. You can check out your whole portfolio or go deep into individual stocks, and for dividend investors, this is where Snowball really flexes. It tracks your income down to the penny, shows you an event calendar so you know exactly what's coming from your stocks over the next few months. It can even predict future income. And there's a backtest feature so you can see how you stack up against the S&P 500 or any index for that matter. If you want to try it, hit the link in the description. You'll get a free 2-week trial, and if you stick with it, there's an extra discount waiting for you at the checkout. The second stock in the portfolio is Legal & General, one of the UK's largest financial services and asset management companies. They're known for insurance, pensions and investment management, and they earn money through insurance premiums, management fees, return on invested capital and annuity profits. Legal & General also reinvests its profits into high quality long-term assets that match its pension and annuity liabilities, making it a strong and reliable long duration investment. As we can see, year to date they're up 8.5% and their current price is £2.50. They're part of the financials industry, have a market cap at 14.08 billion, went public back in 1976, have a 16-year dividend growth streak with a 5-year dividend growth rate of 4.1%, and have a current dividend yield that still sits at a very high 8.59%, and it is actually one of the highest in the FTSE 100. Right now, the analyst consensus is that it's between a hold and a buy, with there being 1 strong sell, 2 sales, 7 holds, 4 buys and 1 strong buy. And this means their overall analyst forecast is that the price target is 260p, which is around 6% above the current price. I own Legal & General because it's a stable, reliable business that delivers consistent income and long-term growth. As a leader in pensions, insurance and asset management, it benefits from an ageing population and rising retirement demand. With a dividend yield that's above 8%, strong cash flow and a solid balance sheet, it provides dependable income. Its focus on real assets like housing and infrastructure also adds steady, inflation-resistant returns. Overall, Legal & General is a true sleep well at night stock, which is why it's a core part of this portfolio. Next up, we've got B&M Bargains, which is one that's featured quite a lot recently on the channel. B&M Bargains is a fast-growing discount retailer built on high volume, low margin sales, strong cash flow and consistent shareholder returns. They operate around 865 stores across the UK and France, plus over 300 Heron Food stores. They're actually aiming to open over 1,200 total UK stores and have opened 47 new stores just last year. B&M is the only stock in my UK dividend pie that's not listed on the London Stock Exchange because it's currently based in Luxembourg. So UK investors do currently face a 15% withholding tax on dividends, but there is good news about this, as it was recently announced they are relocating their headquarters to Jersey, so when this is finalised, the 15% withholding tax will be no longer. And if you have watched any of my other videos, you will know how much they have struggled this year, as we can see, being down 56% year to date, with a current price at £1.60. They're part of the consumer industry, have a market cap at 1.61 billion, went public in 2014, do disappointingly have a 0-year dividend growth streak, but have a slightly highly inflated 5-year dividend growth rate at 35%, and this is due to them paying some special dividends, which has inflated that number, so take that with a pinch of salt. And they do have a current dividend yield that sits at 8.22%. The analyst consensus at this current price is that it is a buy, with there being 2 sells, 4 holds, 9 buys and 3 strong buys, with an overall price target at 254p, which would be around 60% above the current price. And although B&M have struggled this year, I own B&M because it's a pure play on value retail, a sector that performs well in both good and bad economic times. As inflation pressures consumers, more people turn to discount retailers, and B&M's low-cost, no-frill model positions it perfectly to benefit. With efficient sourcing, strong cash flow, and a fast-growing store base across the UK and France, their business consistently delivers solid returns. What I really like is its ability to generate high returns on capital, expand rapidly without taking on heavy debt, and return meaningful cash to shareholders, often through special dividends on top of a reliable base yield. The share price has dropped recently, but I don't see it as a concern. I believe the company can bounce back, especially with the new CEO at the helm. B&M isn't flashy, but it's a simple, scalable, cash-generating business built to withstand economic cycles, which is exactly why it's a long-term hold in my UK dividend pie. Next up is the best performer in the portfolio, which is a British American Tobacco, and this is one of the world's largest tobacco and nicotine companies operating in over 180 countries. Traditional cigarettes still drive most of its revenue, especially in emerging markets, but the company is rapidly shifting towards reduced risk products. They have multiple new products, they are all growing fast and form a key part of BAT's A Better Tomorrow strategy to move beyond traditional smoking. As we can see, year to date, they're up 44% with a current price at £41.47. They're part of the consumer staples industry, have a market cap at 90.22 billion, went public in 1912, have a 9-year current dividend growth streak with a 5-year dividend growth rate at 2.59% and a dividend yield that currently sits at 5.79%. Right now, the analyst consensus is that it's a buy, with there being 2 sells, 4 holds, 5 buys and 4 strong buys, with a current price target at 4,500 pence, which is around 4.77% above the current price. I own a British American Tobacco because it's a reliable cash flow machine with a long track record of paying and growing dividends. Despite regulatory pressure and ESG concerns, the company continues to deliver strong earnings and high margins, supporting a hefty yield that currently sits over 5%. What I like is that BAT isn't standing still. Its next-gen products like VUS, Glow and Velo are becoming a bigger part of the business, showing its planning for the future. It's steady, defensive and quietly compounding in the background, which is exactly why it remains a core holding in this dividend pie. Next up, we've got Greencoat UK Wind, stock ticker UKW, and this is a UK listed investment that's part of the FTSE 250. Their revenue is generated from selling clean electricity to suppliers and benefiting from inflation-linked subsidiaries. Their goal is to provide an inflation-linked dividend and preserve capital over the long term, reinvesting surplus cash or returning it to shareholders via buybacks. This means that their huge dividend payment should be growing at the same rate of inflation, so your dividends won't be shrinking year after year and you can enjoy the high dividend yield too. As we can see on screen, their current price is 96 pence as they've had a pretty disappointing year so far, being down over 24%. They're part of the utilities industry, have a market cap at 2.1 billion, went public in 2013, have a 7-year dividend growth streak with a 5-year dividend growth rate that sits at 9.68% and a yield that's now above 10% for the first time. We can see overall the analyst consensus is that there's 2 holds, 2 buys and 1 strong buy with a price target around 137 pence, which is around that NAV price, which would be 42% above the current price. I own Greencoat UK Wind because it provides rare, inflation-linked income backed by real wind farm assets. With a dividend yield at over 10% currently, supported by long-term government-backed contracts, it delivers steady and predictable cash flow. The dividend is covered nearly twice over, and with the shares trading at a discount to NAV, I'm effectively buying £1 of assets for under 80p. Their dependable, inflation-beating income from the clean energy transition is exactly why I have it as part of my UK dividend pie. Next up, we have Safestore Holdings, stock ticker SAFE. They offer storage units ranging from small lockers to large containers, targeting both personal and business customers, supported by services like insurance and packing supplies. Safestore is actually the largest in the UK and second largest in Europe, with around 200 facilities across the UK, France, Spain, the Netherlands, Belgium and in Germany. They own a mix of freehold and leasehold sites with a strong presence in London and over in Paris. As we can see, year to date they're up around 7.5% with a current price at £6.92. They are part of the REIT industry, have a market cap at 1.51 billion, went public in 2007, have a 7-year dividend growth streak with a 5-year dividend growth rate at 12.65% and a dividend yield that currently sits at a very solid 4.41%. As we can see, the analyst consensus is that it's around about a buy with 1 sell, 6 holds, 2 buys, and they actually have 5 strong buys with a price target at 772 pence, which is around 12% above the current price. I own Safestore because it offers a rare mix of reliable income, long-term growth and resilience. As the UK's largest self-storage provider with expanding operations across Europe, it benefits from steady demand in busy urban areas where space is always limited. What sets it apart is its consistent, inflation-beaten dividend supported by high occupancy, strong cash flow and a conservative balance sheet. Even in tougher economic times, people still need storage, making it a recession-resilient, low-volatility REIT. And for me, this is one of the best UK REITs on the market, exactly what I want in a long-term dividend stock. Next up, we have Bunzl, which is a global distribution and outsourcing company that supplies everyday essential products like packaging, cleaning supplies, safety equipment, and healthcare consumables to businesses. It operates across North America, Europe, and the UK, acting as a one-stop shop for non-food supplies. Bunzl is known for steady revenue, reliable cash flow, and a long track record of consistent dividend growth. Year to date, the company has struggled though, being down a massive 35% with a current price at £21.33, which for me just shows that there's an even better opportunity to buy into the company right now. They're part of the industrials industry, have a market cap at 6.89 billion, went public in 1957, have the biggest dividend growth streak of all the stocks I own within this portfolio, with it being 33 years, a 5-year dividend growth rate at 6.81%, and a very respectable yield that currently sits at 3.47%. As you can see right now, the analyst consensus is that it's between a hold and a buy, slightly more towards the hold, because if we click onto it, we can see there's 2 strong sells, 2 sells, 7 holds, 6 buys, and then 2 strong buys, with a price target around about 2,569 pence, which would be 18.62% above the current price. So Bunzl is part of my UK dividend growth pie because it's one of the most reliable compounders on the London Stock Exchange. The company sells essentials, everyday consumables that businesses always need, things like packaging, cleaning supplies and safety equipment, just like I mentioned earlier. Bunzl has a long track record of growing both its earnings and its dividend, backed by strong cash flow and a highly diversified customer base across multiple countries and sectors. It also grows through smart, bolt-on acquisitions, adding new businesses every year without taking on big risks. Overall, Bunzl is stable, defensive, consistently profitable, and quietly compounding over time, exactly the type of quality stock I want within my UK dividend growth pie. Next up, we have Shell, stock ticker SHEL. It's a fully integrated oil and gas giant involved in everything from exploration and production to refining, chemicals, distribution, and LNG. Shell is one of the most profitable energy companies in the world, operating in over 140 countries with around 90,000 current employees. While fossil fuels remain its core focus, Shell is also investing in low carbon areas like carbon capture, EV charging, and selective renewable projects. The company plans to keep oil production steady and grow its LNG output by 4 to 5% a year through 2030, positioning itself as a major global leader in natural gas. As we can see on screen, year to date they're up over 10% with the current price at £27.40, and I did used to own BP alongside Shell within this portfolio, but I wanted to cut it down so I only had one of the two, and after further research, I definitely think Shell is the stronger out of the two. They have a market cap at 157.8 billion, went public in 2005, have a 4-year dividend growth streak with a 5-year dividend growth rate at 8.48%, and a dividend yield that currently sits at close to 4%, with it being 3.96. And we can actually see right now the analyst consensus is that it's a buy, with there being 10 holds, 11 buys and 1 strong buy, with a current price target around $43, which would be 20% above the current price. I own Shell because it's a cash flow powerhouse with global reach, real assets and a deep commitment to shareholder returns. Even in a volatile energy environment, Shell continues to deliver a 4% dividend yield, regular share buybacks, and one of the strongest balance sheets in the sector. What makes it stand out in my dividend growth portfolio is the combination of resilient earnings, exposure to high margin LNG, and its steady transition towards lower carbon energy, all while still rewarding investors today. So it's not just a bet on oil. Shell gives me reliable income, inflation protection, and upside potential, which is exactly why it earns a place in my long-term portfolio. And although this sector can be volatile, you've just got to ride out the waves, and over that longer term period, I do believe they will come good. And to finish off my UK dividend growth portfolio, I have the most well-known Geordie stock on the market, known as Greggs, stock ticker GRG. Greggs is a Newcastle-based UK food-on-the-go bakery chain offering savoury pastries, sandwiches, hot drinks and snacks like their famous sausage roll and vegan alternatives. They have actually featured quite a few times on the channel recently with that share price drop, as I do believe they're one of the best value UK dividend stocks on the market right now. They operate over 2,500 branches, including high street, motorway services, transport hubs, franchises, and delivery via Just Eat and Uber Eats. They are fully vertically integrated with 21 manufacturing sites supplying the chain, enabling fast product innovation and strong cost control. They do generate most of their revenue from bakery and pastry items, with it being at over 70%. And they have a focus on store expansion, having opened 223 new stores last year alone. As we can see, year to date, it's another stock that has struggled, being down over 41% with a current price at £16.23. They're part of the consumer industry, have a market cap at 1.65 billion, when public back in 1984, have a 4-year dividend growth streak with a 5-year dividend growth rate at 7.87% and a dividend yield that sits at 4.25%. As we can see right now, the analyst consensus is that it's between a hold and a buy, with 2 sells, 5 holds, 6 buys and 2 strong buys, with a price target around 20% above the current price at 1,952 pence. So I own Greggs in this portfolio because it combines everything I look for in a dividend growth stock: brand strength, consistent earnings and smart expansion. It's a household name in the UK that performs well in both good times and bad, and that's exactly the kind of resilient stock I need in this portfolio. With strong free cash flow, no debt and a growing dividend, it's exactly what I want. Greggs continues to show its investment in growth through the new stores, delivery products and drive-thrus. It's a well-managed, vertically integrated business that knows how to scale without overreaching. For me, Greggs is more than just sausage rolls. It's a reliable, compounding machine for long-term income and growth. My UK dividend growth portfolio is built around a simple principle: resilient businesses, consistent cash flow, and long-term compounding. Each of these companies plays a strategic role, not just as individual winners, but as part of a well-diversified pie that balances income growth and stability within the UK market. And remember, this portfolio isn't built for the short term, so although a few of these stocks may have struggled this year with the likes of B&M, Greggs and Greencoat UK Wind, I do believe if you are in it for the long term, it will pay off over that longer term period. You've just got to be patient, ignore the noise and continue investing into the portfolio on a monthly basis. So if you're sitting there thinking, I want a piece of that pie, well, there's good news. As I mentioned at the start of the video, you can copy this exact pie over on Trading 212 by simply clicking the link at the top of the description. If you enjoyed this breakdown, smash that like button, and remember, if this video hits over 100 likes, then I'll do a similar breakdown for my US growth dividend pie. Until next time, keep compounding and stay patient in the market, because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.